Dividend investing sounds like the dream, right? You only buy stocks that are known for paying and growing their dividends for a long time. You sit back and collect passive income, rinse and repeat, and soon you have a snowball effect and you're drowning in dividends. You then proceed to fire, coast fire, lean fire, fat fire, geographic fire. Well, hear me out. There's another side to this story. What if I told you that dividends are irrelevant or even inevitable? That sometimes companies, they can be a bit sneaky and they finance dividends the wrong way. And if you stay until the end, I'll give you a practical example of why you don't want to narrow your investment scope. Hello everyone. Today we're breaking down the shortfalls of dividend investing. If this sounds interesting to you,
giddy up.
Let's start with the biggest misconception about dividends. They're not extra money. They're just moving from one pocket to the other.
Great. Self 5.
Now, imagine you are running a lemonade stand. You are selling in your neighborhood and you have a lot of success. And at the end of the day, you have $100 of profit. And you have basically two options. You can either reinvest in your lemonade stand, like buy a better looking stand or buy some ads in the local newspaper, advertise your lemonade stand, or you can just pocket the money and, I don't know, buy the new Indiana Jones PS5 game. They're both good choices, both solid. But either way, that money is already yours. You own the lemonade stand. So whether you decide to pay yourself and buy that game or you decide to invest in the business, that money was already yours. This is key for people to understand. And this phenomenon is what's called ex-dividend date, which on the date that the company pays a dividend, the stock price typically drops by the dividend amount. So if a company's stock was worth $50 and they paid $1 in dividend to their shareholders, that stock will now be worth $49.
And it makes sense, right?
That company does not hold that capital anymore. So say a company was worth $1 billion, right? And they distributed $100 million in dividends. Well, now they're worth $900 million, right? And this is seen in the ex-dividend date. So just to recap, you didn't gain anything when the company paid you the dividend. You just moved value from one pocket, the stock, into another, cash. So if dividends, they don't create wealth and they are relevant in that sense, why do companies pay them? Well, for that, we need to look at, like living organisms, companies go through life cycles. Early on, a company will be focused on growth, reinvesting profits, expanding operations, and taking on risks. Think of Amazon in the 2000s, Tesla in the 2010s, or any startup for that matter. But as companies mature, they reach a limit of the market share they can capture. When they don't have anywhere to grow and no reasonable investment opportunities, instead of retaining all their profit, companies can start handing out dividends. Think of Pepsi and Johnson & Johnson. And this is where many investors get stuck. They'll only look at the high dividend yield and assume it's a great investment, when in reality, it's more complicated than that. The key thing to understand is that the growth companies of today will become the dividend companies of tomorrow. This is the natural life cycle of a business. This allows you to better understand the company you decide to invest in and what to expect from that company. But here's a nuance. Are dividends really the best use of capital? To answer that, we need to look at now, if a company doesn't pay dividends, what else can it do with its profits? Let's break it down. 1, it can reinvest in the business. Think Apple investing to make a better iPhone. 2, buy another business. Think Facebook acquiring Instagram.
A company with only 13 employees bought today by Facebook for $1 billion.
And 3rd, it can pay dividends, which is nice, but they're taxed twice, at the corporate level and at the individual level. And then 4th, a company can buy back shares, which actually benefits long-term investors without triggering that tax bill. So as you can see, companies have many options on how to use their hard-earned profits. And dividends, they aren't bad, but they might not be the best use of capital. And sometimes companies don't even have the cash to pay dividends in the first place. Here's where dividend investing gets risky, especially for those that only look at the dividend yield. Some companies go to insane lengths to maintain their dividends, even when they cannot afford to. Companies will do this in 2 ways, either by issuing more debt, which can be catastrophic to a company, or by issuing more shares and using that funding to pay for your beloved dividend, which is terrible for investors because it dilutes them. So you ask yourself, why do companies do this? Well, some companies, they see themselves forced to sustain their dividend policies because of something called the clientele effect. The dividend clientele hypothesis, first proposed by Miller and Modigliani in 1961, posits that a company's dividend policy attracts a specific group of investors whose preferences are aligned with that policy. So the risk is that if you remove that dividend, the investors that invested in that company primarily for dividends will sell and the stock price will tank. Now, if you're still here, thank you so much. I really appreciate your time. As you can tell, this is my first YouTube video ever. I'm not quite sure what this channel will be about, but I do know that finance and economics are topics that interest me, and I'll try to broach them in a light way. And if you're into that, feel free to the classics, like, subscribe. And if you don't want to do that, that's fine too. I'll see you around. Now, let's continue. And here's the biggest issue of investing only in dividend stocks. You're ignoring a quarter of the market. That means that you're automatically dismissing potentially great companies just because they don't send you a quarterly paycheck. Think about it. Amazon, Google, Tesla, Meta, Berkshire Hathaway, many others, they have never paid a dividend. And yet they've created billions in shareholder value. What's more is that certain industries like tech, they rarely pay dividends, while utilities and consumer staples almost always do. So again, you're not only ignoring a quarter of the market, but you're also overemphasizing your exposure to a few specific industries and sectors, which may not be ideal. Now, for those that are still here, let's have a look at that practical example that I mentioned in the beginning of the video. Let's have a look at Apple. They only started paying dividends in 2012, but if you had invested $10,000 in its stock in January of 2000, you'd be receiving now almost $13,000 in dividends every year. The cherry on the cake is that your initial investment of $10,000 would have grown to almost $2.5 million. But never mind that, I know you only care about dividends.
I don't care about money.
So the question is, are you okay limiting your opportunities just for the sake of dividends? To be clear, dividends aren't bad. In fact, for certain investors, they're a great strategy. But like everything in finance, there's nuance. That rhymed. The takeaway, don't let dividends be the only thing that matter. Well, let me know in the comments, are you a dividend investor or a growth investor, somewhere in between? And that's it. See you in the next one. Ciao.